Hello, everyone. I hope you can hear me. There we go, just making sure the camera was working. My apologies for the delay there. There we go. It is wonderful to be with you. And Sagni, thank you so much for that presentation. It is so important that we have those right goals. And so many of us, even when we think we have good goals, as Sagni showed us, actually we're not getting to the heart of the matter. We're not able to use our assets in the right way. So a wonderful invitation to us all there from Sagni to get our goals right at the start of this investment journey. Now, we're going to shift track a little bit. I'm going to spend a little bit of time now talking about the global landscape for investors. I'm going to do a little bit of looking back and providing some context for where we are today, and then also some looking forward as well. As all investment actually is forward-looking. It's focused on the future. It's focused on how we get to those goals, and we'll be coming back to that in a moment. So let's get cracking then, and we'll get on to the first slide. There we go. And we're going to start with one of my favorite investment quotes. If you've been investing for a while, you'll be familiar with Warren Buffett, I'm sure, one of the world's most famous investors, one of the most amazing contributors to the success of investors around the world. And Warren said this: to invest successfully over a lifetime does not require a stratospheric IQ, or doesn't require someone to be very intelligent, unusual business insights, or inside information. What is needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. The heart of investing is to have a strong process for the way that you invest, and also to resist the emotional challenges of investing. Our emotions drive so much of our decision making, and in investing that can be disastrous. And so as we go into the next slide, I want to show you the framework that we use to make these decisions. And we would call these our investment principles. And there's lots of different ways that you can make investment decisions, but our principles are designed to help us have that framework, but also keep emotion out of the investment decision-making process. And you'll see here, there's 7 investment principles. I'm not going to go through them today. We don't have time to go through them, but I just want to highlight a couple for you to bear in mind as we think about investing, as we think about the markets. The first is that we are long-term investors. And when we're investing, it's very tempting to think about the next move in markets, the next price that will be printed by a share or by an index. It's very tempting to forecast the local economy and earnings, but that tends not to be the best way of investing. It's very, very difficult to do consistently well. And as we become short-term orientated, it's very easy for us to make mistakes. And so when you're thinking about investing, I want to encourage you to always focus on the long term. Focus on how you reach those goals that you went through with Sagnit, not what's going to happen in share price over the next days, weeks, or even months. So keep that in mind. The second is that we are valuation-driven investors. And when we're thinking about investing, it's very easy for us to assume that what's happening in the economy, what we see around us, what we see in the news, is driving asset prices. But really, if you want to be a successful investor, then you need to be thinking about the value of the assets that you're buying. Sometimes when we see a great company, and we want to buy shares in that company, we want to participate in the growth of that company, then we forget that the success of our investment is not just tied to the success of the company we're buying, but the price that we pay. If we pay too much for those shares that we're buying, we may have a negative return, even if the company continues to do well. And that's because when we're buying shares, that share price doesn't necessarily reflect the true value of that business. It reflects a combination of the value of the business and also investors' perceptions And investors' perceptions, as we saw, are often driven by emotions. And so if people are feeling very excited about a particular company, if people feel like us that this is a great company, then that can push the share prices far too high. And equally, if people are feeling very morbid, very down about a particular company or a particular time in markets, then that can drive the prices well below what their fair value is. So again, try to separate out valuation from the prospects of businesses. And the third one I want to highlight is the importance of fundamental analysis, the importance of diving below the headlines and looking at what's really going on in companies and markets. And I'm going to spend some time with you today trying to go a little bit deeper into the economy, a little bit deeper into what's been happening in markets, and then draw some conclusions which I hope will help you on your investment journey. Okay, let's move on to the next slide, please, and then the one after that. And we'll look at what's been happening in investment markets over the last 10 years. We can just move on one more. There we go. Brilliant. Thank you. So this is the return that you'd have received if you'd have invested alongside these indexes of market returns over the last decade. Now you'll see we have US markets at the top and then more global markets in the middle and bond markets further down. Important to remember, of course, the US markets, the biggest markets in the world, the biggest economy in the world. And so a lot of what I'm going to be talking about to you is going to be focused around the US, because what happens in the US drives so much else. But as I said, we'll be digging beneath that. So what you'll see is that over the last 10 years, equities shares have given you a very high return. You can see that at the top of the chart, but it hasn't been an even return. And so you have done much better if you've invested in the US market than other markets around the world. And so the first lesson for us is that it's not only about investing, but it's also about the countries that you're investing in and the importance of having a broad spread of investments. That if you'd been an investor over the last decade and you hadn't had any exposure to the US, then you'd have had much lower returns. Now, that may not be the case as we look forward. We'll get into that. But remember, the importance of having a whole range of different assets in your portfolio is so important because there are times when one particular market will dominate returns everywhere else. And you can see, of course, over this period that shares at the top have done much better than bonds at the bottom, but bonds have produced a positive return. That's really been a golden period for investing, where the assets that you hold to try and protect your capital have done well, even though the equities, the shares that really drive the growth in your capital, have produced very, very high returns. So it's been a really great time to be an investor over the last few years. But as we get into the near term, we can see a very different picture. So if we move on to the next slide. Thank you. What you'll see here is the returns year by year. And when we look at returns year by year for equities in the blue and bonds in the red, what you'll see is not only that they vary year by year. So that picture I showed you of the decades, not the full picture. They vary year by year, but also when we look at 2022, the year that's just finished, then we had a negative year, not just in equities, but also in bonds. It's a really tough year for investors, because you feel the pain whether you held equities or bonds. And that can, from an emotional perspective, that can be a very difficult year. And so although we had that very long period of upward moving prices, the last year has been very difficult. Now, what that means, of course, is that prices have got lower, and that's actually better for investors. Investors are able to buy assets at lower prices, and we'll come back to that a little bit later on. But let's move on again. And you'll see that when we look at what's happened over the last 2 years, again, there's been differences in markets. So as you look at this chart, we're showing the US market in blue, the developed markets in yellow. And of course, the US dominates that, so that line is quite similar. And then the emerging markets there in red, much lower returns. And so even when we're talking about markets doing well and the high positive returns we've seen over the last decade, we see over the last 2 years that emerging markets have done much worse than the US markets or the developed markets. And that creates an opportunity for investors in the emerging world and the developing world, investing across those regions, because prices are lower, as I said. and so that can deliver higher returns in the future. Now, the key driver of what's been happening in emerging returns, as you probably know, is what's been happening in the Chinese equity market. Chinese equity market makes up a big part of the global equity markets now, and a huge part of the emerging markets. And so what's been happening in China has driven prices lower there. But nevertheless, you can see that over this period, even though equities and bonds have fallen over the last year, there's still been differences between different equity markets. And if we can move on again, we can see that evolution of the US market and what's happened over the last few years. And this breaks down the market into different areas, specifically into the broad market, and those are the lines at the bottom of the chart, and then also technology-related companies, and within technology-related companies, what were known as the FANGs. So they're really large technology companies in the US. So that would include Facebook, although it's called Meta these days, Amazon, Apple, these companies. And you can see that these companies grew their share prices very, very strongly in 2000, 2001. And that was partly related to the pandemic, related to the fact that people expected the incredible growth that we saw during the pandemic in these companies to carry on forever. And so this is a great lesson that when we have very high periods of growth at companies, they don't necessarily carry on forever. But as investors think about how well these companies are doing, they can extrapolate into the future. They can expect these returns to go forever. And as they do that, prices rise and rise and rise, as we saw here. But that can't go on forever. That at some point, that optimism is broken. And we saw that happen towards the end of 21 and into 22, that those share prices in those stocks and technology stocks generally fell very sharply and now are much closer to the broad market. And so again, when you're thinking about differentials, it's not just across markets, it's not just through time, it's also in terms of what drives returns as well. So moving on from that, the picture is even clearer when we look at the difference between what's called growth stocks and value stocks. Now, I don't like this classification. I don't think it's terribly helpful, but it's useful in the context of this chart because it shows you that companies where people expected long-term high growth in that business, they had very sharp upward price movements that we didn't see in stocks that people believed were slower growing, less exciting. But we can see here that those technology stocks, those growth stocks, became very overvalued and now have come back. Whereas over the last year or so, value stocks, you'll see, have hardly dipped. If you'd been in very boring stocks in the US, then actually you'd have preserved your capital. You wouldn't have benefited from the sharp rise in the previous year, but you'd have held on to your capital last year because when those expectations for growth stocks fell, then there were much lower expectations in value stocks. And so that didn't impact those as much. So that, again, speaks to the importance of having different types of companies, different types of markets in your portfolio. Moving on from there again, we can see the difference at a individual sector level. So as we think about last year, one of the things that's worth remembering is that actually energy companies did very well last year, and even industrials, that's a very broad group of companies doing lots of different things, but most of them are in slower growing areas of the economy. They also produced positive returns. And now people will think about energy companies and of course focus on the terrible invasion of Ukraine by Russia and the impact that had on global energy markets. But energy stocks were already starting to do well before the invasion because they'd done the right things during the pandemic, stopped investing so much money and started making sure that they had a strong financial situation and were paying returns to investors. So energy companies had already started doing well, they held up very well last year, whereas as you get further to the right of this chart and you look at other parts of the market, they did poorly. And then right at the end, you can see we have technology, consumer discretionary, which is dominated by Amazon, which of course is a technology-related business. Then right at the bottom, you have communication services, which is where Meta and Alphabet, the owner of Google, sit. And so all those businesses are really those high growth technology-related companies that everyone was excited with. They performed very poorly, but other markets performed well last year. Okay, let's move on from there, and what we'll see is that this pattern of sharp sell-offs and high returns is not unusual. It's something that we all need to expect as investors, and this is why it's so important to be long-term orientated. This is a chart that shows the average number of 10% declines in the US market over any given year, and this data goes back to 1960, I think, and you can see here that in most years there's a 10% decline at some point, and some years you don't have that, and they're seen as very good years, but often you'll have a number of these 10% declines, and that's why it's so important not to respond to every change in the market. Otherwise, you'll be constantly changing your portfolio. You'll be feeling terrible when the market is down, which frequently happens. You'll be feeling great when the market's up, and that can lead to very poor decision making. So just remember that these periods of falling markets are perfectly normal when you're investing. They're not something to be worried about. And that's further illustrated in the next slide, where we show the returns of what we call a 60-40 portfolio. So that's a balanced portfolio where about 60% of the capital is invested in shares, in equities, and about 40% in bonds. That's a very standard portfolio around the world. We can see the returns of a 60-40 portfolio here after some of the big market events that either maybe you've lived through or you're very familiar with. And you can see that the light blue lines, after about a month when these events happen, it's seldom that people have had a high return on their portfolio. Not much typically happens after 6 months. In some cases, after a year, you're still down compared to where you were before these events. But you can see that after 3 years and after 5 years, that's when the returns come. And that's why it's so important not to respond to every decline in the market, because as long as you remain focused on your goals, remain invested, obviously in the right combination of investments, that's important, then you'll benefit from that long-term upward movement in markets. So I just want to encourage you that despite the falls we've seen, that hasn't been the whole story. And even where you have seen falls, that's where the importance of being a long-term investor comes in. So let's move on then. I'm going to go past these global sector returns, which just show you again there's been variety this year in terms of the returns. It's turned around. Some things did well last year, haven't done so well this year. Again, that illustrates the point again. And I want to go straight on to looking at the economy, the macroeconomic background in the interest of time here. So if we can move on just a couple of slides, please. There we go. And on to the next one. That's it. Fantastic. What we'll be familiar with over the last year is that inflation has come much more into the foreground, and you can see that here in this chart. This shows the consumer price index, the common measure of inflation in the US, and you can see there's been a very sharp rise in inflation over the last year. And again, that's driven a lot of the decisions around the economy. But as we think about all the economic data I'm going to show you in the next few minutes, it's so important to remember that this data is backward looking. It tells you what has happened, whereas investment is always forward looking. But you can see here there's been a very sharp spike in inflation. And when we move on from that, you'll see that, again, this inflation has not been uniform. We've broken down inflation here into three main parts. And as we look at those three parts, you'll see that core goods was what spiked the hardest. And this makes sense because when you go through the pandemic and supply chains are broken, goods aren't able to move around the world. And then when the economy reopens and people have savings that they want to spend, then it's difficult to get hold of these goods. We saw a very sharp spike. But look what's happened more recently. We've seen a very sharp fall in the inflation of consumer goods. The price isn't rising nearly as quickly as it was, whereas some other parts of the market, so consumer services, again, remain high. People are still out there spending money, and that's creating demand. But remember that that's not the whole story, that actually some of the pressures coming off inflation because of what's happening with consumer goods. And then moving on from that, we can see it in more detail. What are these different components? So you can see here that over the last 12 months, transportation was one of the biggest drivers of inflation in the US. Food and energy that we've talked about, they're partly related to the wars I mentioned. Shelter's been very high, but other parts of the market have been showing less strong price rises. And used cars, which rocketed in price, and that's linked to those consumer goods numbers I showed you a moment ago. They've actually been falling in price. So again, there's unevenness. But when we look at food and energy, the first thing to remember about those as drivers of inflation is that can reverse very quickly. So as you'll all know, the harvest is variable and supply chain is variable, and food prices can adjust very quickly. And so again, we shouldn't rely on food prices continuing to rise. Equally, we're already seeing energy prices come down as people readjust supply chains and energy needs and energy consumption to the tightened supply. So again, these parts of inflation can turn around very quickly, and it's important to remember that. And you can see that illustrated in the next slide, where we've looked at energy prices, and they're sharply off their peak. They're at very normal levels now. This is oil prices specifically. Obviously, gas is a different commodity, as is coking coal and others. But we're now seeing energy prices at a pretty normal level as we go back through time. And so again, that's worth bearing in mind, that there's not that great push from energy prices at the moment. That could change, but it's not there at the moment. And then moving on, we can see that one of the other big drivers of demand in the economy, other big drivers of inflation, is the intervention by central banks over the course of the pandemic to try and help people around the world get through the pandemic by not losing their income at the same time as they were unable to work or battling with their health. And so you can see that the big central banks, led by the Fed, which is the US central bank, obviously the biggest in the world, they increase the size of their balance sheet. What that means is that they created a lot more money over that COVID period, and that money supported the economy, and that eventually drove inflation to some degree. And what we're seeing now, you see those numbers are rolling over. That the Fed is no longer increasing its balance sheet. In fact, it's reducing its balance sheet. And again, it's more focused now on inflation than promoting growth. And that's what's led to some of those declines in prices that we saw, as people are more worried about the future. So moving on from that, we can see the impact this has on people like you and I as we're thinking about the future and what inflation may be. That when people look ahead at inflation, if they think about the next year, then people are still expecting inflation to be high in the US. You can see that in the blue line, but far less high than they were expecting just a few months ago. And so inflation expectations for the year ahead are coming down sharply. But when we look at the 5-year inflation rate, so really a more impactful measure of inflation, what's going to happen over the next 5 years, those inflation expectations are still very anchored towards a long-term average. So about 2.9% at the moment, slightly elevated, but you can see that red line is roughly where it normally is. People are expecting a low level of inflation. And of course, as people change their expectations around inflation, that changes their patterns of saving and buying and investing. So it's worth remembering that although the newspapers are still focused on inflation, the central banks still focus on inflation, people's expectations of inflation are falling. And so that's impacting central banks. We can see that on the next slide. So when people think about the next move in US interest rates, you can see there it moved up very sharply. That's the blue line, very recently from very low levels during the pandemic. People are expecting interest rates to fall sharply in the US over the next few years. Now, it's important to say that these sorts of forecasts are often incorrect. And so I wouldn't set very much store by them. I certainly wouldn't invest on this basis. but it's just worth understanding that people are expecting interest rates to fall, and that's what's driving some of this optimism that we've been seeing in markets over the last couple of months. Now, of course, if that changes, if people expect interest rates to rise again, then some of that optimism is likely to go away, and we may see share prices, global share prices, falling again. But remember, this is all just the normal ups and downs of markets. The next move in interest rates in the Fed is not going to have a material impact on your ability to reach your goals, providing you stay focused on the long term. So moving on from that slide, we can see there's not just the Fed that's raised interest rates, but we can see this pattern around the world with the Bank of England in red and the ECB as well. So the developed world is currently moving in lockstep in terms of interest rate policy, and that's having this global impact that we're seeing tightening financial conditions, that money is more difficult to borrow, that rates are higher, and that's making it more difficult for companies that aren't financially secure to continue. And so what we're seeing is a focus on the quality of businesses and their ability to continue to deliver returns in the future. And when you have a situation where interest rates are very low and money is very easy to get hold of, that supports all businesses. But when financial conditions are harder, then that's typically separates the good businesses from the bad businesses. So just be aware of that as you're thinking about investing for the long term, that in these sorts of conditions, the quality of businesses is very important. So moving on, again, what we can see is the impact that those higher interest rates have had on the value of the dollar. And you have seen this if you follow currency markets, that as the interest rates have raised, and as the Fed, although everyone's been moving together, the Fed has been pushing those rates higher because it's had the strongest economy, it's most worried about inflation, then you'll see that the dollar has increased in price. And again, that produces more of a squeeze on companies, and that helped drive prices lower over the last year. But you can see, if you look at the very right-hand side of this chart, that more recently the price of the dollar has been falling, and that's been easing conditions around the world, and also reducing the value of gains in the US market if you're investing outside. And then let's go on another slide, and what we can see is the impact that all of this is having on consumers. And we can see these different measures of consumer sentiment have dived very sharply over the last year or two, but more recently have started to recover again. That's the optimism coming through as people realize that the economy in the US remains strong, that inflation expectations are falling, that it looks like the Fed won't be raising interest rates sharply far into the future, that people are becoming more optimistic. And that's a better environment for everyone in terms of how we feel about the world. But remember that greater optimism tends to lead to higher prices, which can be worse conditions for investors. As investors, we should like low prices when we're buying. Obviously, we want high prices when we're selling, and that's when we're retiring or we're taking our capital, and we have to use it to support our life. But when you're buying investments, then you want these low prices. What we're seeing is as sentiment rises, then we've seen some impact in prices. Moving on from that, one of the big changes we've seen most recently is what's happening in China. But as they changed their COVID policy at the back end of last year, I'm sure you're familiar with the reopening of the economy there and the huge wave of COVID that swept through China. But as they went through that process, we can see that economic activity in China is rising sharply from where it was just a few months ago. And that's something to really bear in mind. Remember, as earlier I was saying about how emerging markets had performed poorly, partly because China had performed so poorly. But we're seeing a rapid reopening in China. That's one of the investment areas that we see as more attractive at the moment, particularly the technology stocks in China. That's an area which has been beaten down over the last few years. There's been lots of negative news, but you can see that China's reopening, and that's beginning to support more optimism there. But prices still appear to us to be quite attractive. And then finally, I want to focus on valuations in this section. So we've talked about valuations being really important. And what you can see on this next chart is that there is this differential still in valuation. So this is the most basic measure of valuation. It's not the best measure, but it's a very useful shorthand. We're looking at the price you're paying for the earnings of these companies in the future, the famous PE ratio. And you can see it moves around quite sharply over time, but in the US, what we've seen is that sharp fall over the last year, but it's still far more expensive than other developed markets and more expensive than emerging markets as well. Now, part of the reason it's more expensive is that there are lots of very high quality businesses in the US, and you'd want to pay high prices for those businesses. And you can see that as you go back through time, that the US typically has a premium price compared to both developed markets and emerging markets because of the quality of the businesses there. But that gap is really quite wide at the moment, and we would think is too wide, and we're seeing real opportunities outside the US. So that's where the markets have been. We've looked at where the economy is, and so we're just going to finish with this last section, looking ahead. How should we think about the world as an investor? I wanted to start with another quote here from Benjamin Graham. So Benjamin Graham was Warren Buffett's teacher. He was a university professor. He was also a great investor. What we call him the father of value investing. He was one of the first people to really think about the importance of value when making investment decisions. And what Ben Graham said was, the best way to measure your investing success is not by whether you're beating the market, but whether you're in a place, whether you put in place a financial plan and a behavioral discipline that are likely to get you to where you want to go. It's about that emotional discipline, behavioral emotional is the same thing. And as Sagneet was talking about earlier, about having that goal and then having a plan to get there. That's the key. It's not about these short-term market movements. And so moving on to the next slide, I want to paint a picture of the investing journey for you. And what I've showed here is obviously very simple and very stylized, but I've shown us as investors, all of us, in that bottom left-hand corner of the chart. And then you can see our goals, these goals that you've put together working with the techniques that Sagneet was showing you up there in the top right-hand corner. And we tend to draw a straight path towards our goals. But we know that in order to reach our goals, normally we have to invest in some kind of asset, and that asset price is not stable. In order to hit our goals, we have to invest in stocks and bonds and companies and markets. And of course, as we've seen, the price doesn't move in a straight line. It goes up and it declines. You can see that stylized here with these emojis, that there is times when we feel great about our investments because the price has risen so far. But you can see at that point, we're ahead of our path towards our goals. But equally, there are times when prices fall and we feel terrible about investing. But the thing to remember is that this is just a path that's moving up and down, but we're continuing to make progress towards those goals. So we need to remain focused on those goals. And our ability to stay focused, our ability to remain invested, to be able to deal emotionally with the ups and downs is absolutely core to our success. And then the second thing that's core to our success is the efficiency of the path in which we're on to reach those goals. You can see from this chart that if we just hold cash, and again, Sagneet was talking about this earlier, if we just hold savings in the bank, then unfortunately we're unlikely to get the return that we need to reach our goals. We're probably going to be missing. The return is likely to be too low. But even when we're on track to hit our goals, where we have it's important we have that right mix of investments. And again, as you're thinking about what the right mix is for you, the overall risk in those investments is important, but equally the valuation of those investments are important. The opportunity to buy things when they're trading cheaply, when everyone else feels terrible about investing, that's a great time typically to buy more investments at low prices. And equally, when people are feeling great about investments, that's normally a bad time to be buying investments. And so think about the efficiency of hitting that goal that you tend to be rewarded when you buy when people feel terrible and do less buying when people feel great. And so moving on, one more slide, you can see in this chart the dangers of not staying on that path towards your goals. What we've done here is we've looked at the market going backwards through that 2008 period, which you may remember, we call it the global financial crisis. And you can see here what would have happened if you'd sold your portfolio when you were feeling the worst about it. So at the bottom of the market. And you can see here that if you'd stayed invested, let's say you started with $100,000, which is a nice round number, but beyond most of us. If you'd started with that amount, now, although you'd have got back to that at the bottom of the market, you wouldn't have made any money. Now, if you'd stayed invested, you would have made about 5 times your money over the subsequent period. If you'd just gone to cash, and obviously this is based on US interest rates, then you'd have made a little bit of money, but not very much over that period, probably not enough to help you reach your goals. But here's the thing to remember. If you'd sold out at the bottom and then invested back into the market just a year later, so when things looked better in the economy, you saw that the crisis wasn't continuing forever, and you invested back into the market, you'd have seen there still a much lower return. That's the red line, a much lower return if you'd sold out and then just stayed in cash for a year. So bear that in mind. The importance is to have a portfolio that you can live with, that can keep you on your path towards those goals. And the good news for you at the moment, and moving on to the next slide, is that actually we are at a better time to be an investor than we were a year ago. This is a very broad measure that we use within the investment team to look at the overall value in markets. And you can see here that we have 3 lines. One is the emerging markets in light blue. We have developed markets in dark blue, and then we break the world into different industrial sectors in orange. And I'm not going to take you through all the mechanics of this, but the higher the line is on the chart, then the better value investments are. And you can see that they were very good value back in 2020 when the market crashed because of COVID. But even now, although prices have risen a little bit over the last few months, we're still seeing much better values in markets than we saw just a year or so ago, a little bit back before that. So just be aware that now is a much better time to invest than it has been over the last few years, and so you're with careful thought and diligence, then there are good investment opportunities there. So stay on the path and think about that long term. So my final slide is a breakdown of our broader market views. And you can see here that we've classified lots of different asset classes in one of 5 buckets. In the middle, we have what we call a medium conviction. We describe our investment views as our convictions. A low conviction means that we are unenthusiastic about a particular asset. A high conviction means that we're very enthusiastic. And what you can see is at the moment, most of the key asset classes that you'll be thinking about are in that medium bucket that we expect fairly normal returns from those assets. There are a few things in the medium to high, including Chinese equities, German equities, where we're seeing good value. There are some that are moving down into the low bucket, but in most areas we'd expect a fairly average return going into the future, and that's not a bad time to be an investor. Now, I'm going to move on to the last slide, which is the compliance slide, which is so important in these situations. And I would love to take questions. Kaustubh standing by, but I think we're almost out of time. Kaustubh, do we have time for just maybe 1 or 2 questions if we have any?
Yeah, absolutely. So Dan, firstly, thank you so much for this really insightful presentation. We do have a few questions. Let me just quickly jump to them. So I think, traditionally from an Indian investor's perspective, I think a lot of focus has gone towards the US stocks and the US equities and not so much. So there's a question, about how do you view European equities, both developed Europe and emerging Europe, if you could share some thoughts around that.
Yes, absolutely. So when we look at European markets, the first thing to remember is that it's not really one market. It all gets lumped together, but it's a vast array of different economies and markets within Europe. And so within the European sphere, we still see good value in the UK market. I still think of the UK as being part of Europe, even though we're not part of the European Economic Group anymore. But we still see good opportunities in the UK. We also see good opportunities in Germany. Germany's had a very tough time over the last few years. Valuations are attractive. There's some great companies in Germany. On the other hand, we're not seeing very good opportunities in the Nordic countries, or in France. We see very low, very high prices, very few opportunities in Switzerland. So when you're thinking about Europe, it's important to be really selective. When we get into developing Europe, then there's some good opportunities there, but it's a very small set of markets, very difficult to access because Russia has formed such a large part of that market historically. So there is some value, but difficult to access.
Thanks, Ed. There's another question around, what is that potential risk that you see that, inflation could get stoked again? What are the watch points that you would be looking out for?
Yes, so that's a really important question, because when thinking about investing, it's vital not to get fixed on one possible economic outcome. And we may have a rise in inflation again. If we look at the US, that the economy is still very strong. If you look at the opening up of China, again, that's going to create demand and could create some more inflation. So that's certainly one outcome to bear in mind, and not be surprised if we do have another spike in inflation. But as we look longer term, we'd expect a move back to fairly low inflation. And so don't be worried if we do have a spike in inflation, but remember that over the long term, we may not get back to the very low inflation we've seen in the last couple of years, but the path is probably towards low inflation looking ahead.
Just closer to home, right? And so, I mean, you obviously spoke about that, you're pretty constructive in emerging markets, China especially. From an Indian investor's perspective, where do you think India stands in the pecking order? Because, we've traditionally always, looked very closely at how foreign investors are investing in India. While that needle might have swung, but, just some insights in terms of where do you see India in the pecking order?
Yes, absolutely. So the first thing to say, I think, is that you are so lucky with the Indian market. It's such a diverse market. And so whenever we're talking about the Indian market, as you all know, it's important not to be too general in your view, because with 30-odd thousand stocks, there's going to be some great companies there. As we look at it at a large cap index level, it doesn't look particularly attractively priced to us at the moment. A lot of the great economic opportunities in India already baked into these prices. It doesn't look bad value. It just doesn't look very cheap to us at the moment compared to some of the other markets that we can find. But again, when we're thinking about India, because of that vast variety of different companies, different opportunities, then there's bound to be good opportunities there. So it's a market, I think, where it pays to be really selective and pick out those best companies because of that variety.
Sure. I think we're pretty much out of time, Dan, but really appreciate your time and these very valuable insights that we take away from your session today. So thanks again.
It's an absolute pleasure. Thank you so much for having me along.